Today I'm going to be talking about defined contribution plan. Under a defined contribution plan, the amount of contribution payable by the employee is specified upfront. It's usually set as a percentage of salary. The advantage from the employee's point of view is that he knows in advance how much he has to contribute, how much his liability under the scheme is going to be, in other words, how much it's going to cost him, and therefore he can budget appropriately. The Provident Fund schemes are good examples of such plans. So let's look at them in a bit more detail. The Provident Fund schemes can be categorized into the statutory Provident Fund, the various recognized Provident Funds and unrecognized Provident Funds, and of course there is the Public Provident Fund. Starting with the statutory Provident Fund, the scheme was established under the Provident Fund Act of 1925. The fund is controlled and managed by the Ministry of Finance, and government employees are required to contribute 6% of their salary towards the fund, which is also known as the General Provident Fund. The definition of salary here, by the way, does not include dearness allowance. But the good news is that the employee contribution receives full tax relief under Section 80C. The benefits, of course, are payable at retirement, but there is an early withdrawal facility available as well. In other words, if for certain reasons funding is required, then the money can be taken out of the fund. The various reasons covered are specified by the rules, but they, for example, in the event of cost of higher education or advanced education, in the event of illness, the cost of medical cover, medical charges. It can also be used to purchase a house or even a motor car. And if someone is a member of a general insurance scheme, then the annual premium may also be taken out of this facility, through this facility. As far as the maximum amount that can be withdrawn is concerned, is restricted to 1/2 of the fund built up by the member, or 6 months salary, whichever is less. Turning now to the Employees Provident Fund, this fund was set up under the Employees Provident Fund and Miscellaneous Provisions Act of 1952. The Act covers establishments which are listed in Schedule 1 to the Act, with employees numbering 20 or more. As far as the contributions are concerned, the employee and employer are both required to contribute at 12% of salary. Salary here includes dearness allowance and is restricted to or limited to 6,500 per month. If the employer wants to pay more, he can of course do so. In addition to the 12% contribution, the employer is also required to contribute towards the expense of administering the scheme, and in that respect he has to pay 1.1% of the total wages bill. Benefits are available from age 55, but again, early withdrawal facility is available. I'll also mention here that the employee can nominate member of his family or members of his family to benefit under the scheme in the event of his death. So he can name in advance who he wants to benefit from the fund. Next we turn to the Employees Deposit Linked Insurance Scheme. Now this was set up in 1976 and is basically a death in service benefit scheme, under which in the event of the employee not surviving to retirement age, a lump sum is paid. Total amount payable is concerned is restricted to the average value of the fund built up over the last 12 months or over the full membership of the employee, whichever is less. If the amount comes to 35,000 rupees, then he can have the whole amount, or rather his beneficiaries can have the whole amount. If it exceeds 35,000, then the formula is 35,000 plus 25% of the remainder, with an upper ceiling of 60,000. The employee is not required to contribute towards this fund or benefit. The employer has to contribute towards it at the rate of 0.5% of the salary. Again, the maximum salary that needs to be taken into account is 6,500 rupees per month. Any employee who is a member of the Employees Provident Fund scheme is also a member of this scheme. In other words, he can expect benefits under both these schemes. I would mention this, both of these schemes, the Employee Provident Fund scheme as well as the Employees Deposit Linked Insurance scheme, are administered by the Employees Provident Fund organization, which is one of the largest fund institutions in terms of size, and it has a detailed administrative structure, both at regional level, at sub-regional level. It has district offices as well as service centers to help its members. Next, let's turn to the recognized provident funds and unrecognized provident funds. Now, a recognized provident fund is one which has been recognized under the rules of Schedule 4 of the Income Tax Act by the tax inspectors, by the tax commissioners of income tax. The ones which are unrecognized obviously haven't been recognized by the Commissioner of Income Tax, but and has the disadvantage that any employee contributions do not receive any tax relief. Turning next to the Public Provident Fund. Now, this was set up in 1968 under the Public Provident Fund Act of 1968, and any member of the public can contribute towards it. In fact, a guardian or a parent can contribute on behalf of a child as well. The fund matures after 15 years, but early withdrawal benefits may be taken once 7 years have been completed. As far as the contribution levels are concerned, minimum contribution of 500 rupees is required, and the maximum, current maximum, is 70,000 per annum, which is eligible for tax relief. The interest credited to the account is of course tax free, and I will also mention that the fund built up does not fall within the ambit of the wealth tax. So let me conclude by revisiting the tax advantages of these funds, various funds we've been talking about. The employees' contributions of course receive tax relief as mentioned. The employer's contributions are deductible as expenses and therefore receive tax relief. The interest which is paid in respect of these funds, in other words the accumulation rates, are tax free, and also the lump sum which comes out of the fund at retirement are not subject to tax. So these are the various tax advantages. So let me stop there.